Welcome back to Investing Talk Podcast. Today, we're asking a question I know is on some folks' minds. Is Avanos Medical, ticker symbol AVNS, a good time to buy now? It's a company with a pretty big global footprint, and, well, we've waded through quite a bit of information to help you figure out what's going on with them.
Yeah, that's exactly what we try to do here. We gather up all sorts of sources, financial reports, news updates, market data, the works, and we analyze it all to hopefully give you a really clear, unbiased look at companies like Avanos Medical. The goal is simple: help you understand the potential upsides, the risks too, and what it all might mean if you're considering an investment.
Absolutely. We do the digging so you get the insights, maybe even find a few surprising things. And hey, while you're listening, if you get something out of this, please do hit that subscribe button. A like helps too, or leave a comment. It genuinely helps the show reach more people like you. And if you're feeling particularly supportive, you could even consider buying us a coffee. Also, after we wrap up on Avanos today, if there's another company you're curious about, definitely drop its name in the comments. We do look at those suggestions. Okay, so let's start peeling back the layers on Avanos Medical. What I'm seeing is they're in the medical devices space, specifically digestive health and, interestingly, non-opioid pain management products. How significant is that focus?
That's a really good place to start. That focus is key, actually. Digestive health, well, that's a constant need, isn't it? And the non-opioid pain management side, that's huge. With the whole opioid crisis, there's a massive push for alternatives. So their products tap into these really critical, evolving healthcare demands. They're not just any medical device company. They've picked some specific high-need areas. Now, financially, looking at their Q1 2025 results, revenue growth was, let's say, modest, just 0.8% year over year, hitting $167.5 million. That's basically flat, almost stagnant, really, not exactly setting the world on fire growth-wise.
Right, near stagnation. That does sound like a bit of a red flag, especially in this industry. But our sources also mentioned some improvement lower down the income statement. Net income went up from $500,000 to $6.6 million, and adjusted net income from about $10 million to $12 million. Adjusted EPS up to 0.26 cents. So how does that happen with flat revenue? Is it cost cutting or something else? And, can they keep it up?
That's the million-dollar question, isn't it? Seeing net income jump like that is definitely positive on the surface. But context is everything. We need to remember that prior data showed some pretty rough numbers, a negative EPS of negative 8.27, and a negative return on equity, minus 36.78%. So while this quarter looks better profit-wise, it's coming off a really low base and follows significant losses. It suggests profitability isn't stable yet. Operational efficiency seems like it's still a work in progress. This recent improvement might be more about tightening belts than strong core performance. Sustainability really depends on getting that top line growing again, along with keeping costs in check.
Okay, that makes sense. Profitability improving, but maybe fragile. What about cash? They report a healthy free cash flow, $131.3 million. That usually sounds good, right? Gives them flexibility. Our sources didn't get into specific debt levels, but how should we read that cash flow number alongside the weak revenue and the profitability questions?
Yeah, it's an interesting mix. Healthy free cash flow when revenue is flat can mean a couple of things. It could be they're really good at managing working capital, getting cash out of the operations they do have, or maybe they're just not spending much on capital investments right now. For Avanos, it suggests they've got some breathing room. They can fund initiatives, maybe handle debt if they have it. But without the full debt picture or knowing their long-term investment needs, it's a positive sign for cash generation, yes, but maybe not the whole story on financial health for growth. And tying this back to where they sit in the industry, it's a competitive field, medical devices. But as we said, they have this focus. And what's really interesting now is the talk about strategic restructuring, plus a push for innovation, especially with the new leadership coming in. They seem to be really zeroing in on those potentially higher margin areas, like the non-opioid pain stuff, trying to carve out that niche. These moves, they're clearly aimed at boosting both growth and margins down the road. It feels like an attempt to really change their trajectory.
Focusing on higher margins makes strategic sense, definitely. But let's talk valuation. It's kind of puzzling. The forward PE ratio is about 10.80. That seems quite low, doesn't it? Often suggests the stock might be undervalued compared to what analysts expect it to earn next year. But then you look at the stock price. It's fallen hard, from a 52-week high near $25 down to around $12 now. So you have this low forward PE, but also this massive price drop. What's the market saying here? Is it too pessimistic? Or maybe some of those long-term forecasts are just wishful thinking?
Yeah, you've nailed the central puzzle. That forward PE, 10.80, in this sector. Yeah, on paper it looks cheap, undervalued. But the market reaction, chopping the price nearly in half from its highs, That tells you investors are wary. They're seeing that sluggish revenue growth, remembering the past profitability issues, and they're hesitant. They're basically saying, prove it. And it gets even more interesting when you see some of those super long-term forecasts. Some sources project the stock could hit what? $22.61 by 2030, maybe $70 by 2040, even over $150 way out in 2050. I mean, from $12 today, that implies massive upside potential, huge growth. But like you said, the market seems unconvinced right now. It's that classic potential versus execution gap. And those really long-term numbers, they carry that typical, massive uncertainty. So much can change over decades. Highly speculative, really.
Which makes the technical picture, how the stock is actually trading, even more important to watch. It's been volatile, apparently swinging about 2.6% intraday recently, though it did tick up slightly, about 1% to close around $12.01. But the big thing is, it's sitting at roughly half its 52-week high. What does that tell us? Is it finding a bottom here, or is there more pain ahead?
Well, what's noticeable is that despite that huge drop, it seems to be trying to find its footing around this $12 level. It's building a bit of a base. Now, we didn't have specific RSI or mass CD readings from our sources, those technical indicators that measure momentum, but just looking at the price action itself, the fact that it stopped falling so sharply, and you combine that with management talking about strategic clarity, it kind of hints that maybe, just maybe, the stock is stabilizing, like it's consolidating after the big fall. Suggests there might be some support holding around these current prices, maybe getting ready for a move, but it's tentative.
Okay, so beyond the charts and the numbers, what about recent news? Sentiment. Big news was the new CEO, David Pasiti. He seems to be saying all the right things, right? Transformation, focus, cost management, accelerating growth. Leadership changes can be catalysts, but how quickly can one person really turn things around? Especially with that flat revenue. Is this real hope or just talk?
It's always a fair question with new leadership. A new CEO can definitely bring fresh energy and, crucially, a clear strategy. And it seems like the market is reacting with some cautious optimism. That's the phrase our sources used. That optimism probably got a boost from the improved quarterly earnings, too, that better net income and EPS we talked about. It's not like investors are wildly bullish, but it's a shift from the negativity, perhaps. Interestingly, though, the sources didn't flag any major insider buying or selling or big analyst upgrades or downgrades recently, and there wasn't much detail on social media, buzz, or anything like that. So the sentiment seems cautiously positive, mostly tied to the new CEO and that last earnings report.
Okay, so cautious optimism. What could actually kick this stock into a higher gear soon? What are the near-term catalysts we should watch?
Well, the most immediate thing is the next earnings report. That's expected around July 30th, 2025. The consensus estimate for EPS is $0.18. Now, that's actually a bit lower than the $1.26 adjusted EPS they just reported for Q1. So expectations aren't super high, maybe beatable. A surprise beat there could definitely give the stock a lift. Beyond that, catalysts would be tangible signs that the new strategies are working. New product successes, maybe partnerships, evidence the go-to-market approach is improving. And then there are the broader things. Any M&A in their space could shake things up. Regulatory news, good or bad, for their specific devices, or just shifts in overall healthcare spending trends. All those external factors could play a role, too.
Makes sense. But every investment has risks. Let's lay those out for Avanos. We've already touched on operational risks, that weak revenue growth, the past losses. That suggests execution is a challenge, right? What does that mean long term?
Yeah, those operational risks are front and center. If revenue stays weak, it means they're just not grabbing the market opportunities that should be there. And the past losses point to underlying inefficiencies. For a long-term investor, the risk is basically that this turnaround, the one the new CEO is promising, takes way longer than expected. Or maybe it doesn't fully deliver, and that directly impacts whether those big long-term price targets are ever reached. It's a bet on execution.
And then there's the volatility. We saw the stock get cut in half. That's a wild ride. How big of a concern should that be for someone thinking of investing, especially if they don't like huge swings?
It should be a major concern for anyone uncomfortable with volatility. This stock has shown it can move sharply, both ways presumably, but recently downwards. Losing half its value means big drawdowns are possible. For a trader, that might be an opportunity. But for a long-term holder, you need to be prepared to potentially sit through some significant paper losses without panicking. It really underlines the need for, well, a strong stomach and a genuinely long time horizon if you invest here.
And let's not forget sector risks. Medical devices. That means dealing with healthcare reimbursement changes,
Yeah.
right? Regulations, competition.
Oh, absolutely. Healthcare policy shifts can directly hit their bottom line. New regulations can add costs or hurdles, and competition is fierce. They constantly need to innovate just to keep up, let alone grow market share.
Right. And one last point, liquidity. Market cap is around $549 million. Moderate size. But if you're thinking short-term trades, probably worth checking the daily trading volume.
Definitely. Always check volume for short-term plays. $549 million isn't tiny, but you want to be sure you can get in and out easily without moving the price too much yourself.
Good point. Okay, so let's try and bring all this together. Our overall assessment, putting a number on it, we landed at a 6.5 out of 10 for Avanos Medical right now. Why? Fundamentally, you've got moderate strength. Profitability is improving, which is good, but that slow growth is a real drag. Valuation-wise, it looked pretty attractive on that forward PE measure, around 10.8. Suggests potential undervaluation. Technically, yeah, it's been volatile, but it seems to be trying to stabilize in that $11.50 to $12.50 zone. And sentiment, as we said, is cautiously optimistic, mainly thanks to the new CEO and the recent earnings improvement.
But, and there's always a but, those challenges are still very real. Operational efficiency needs work. Growth needs to pick up. And that volatility isn't going away overnight. So weighing it all up, that 6.5 rating feels about right.
It leads us to think of this more as a, let's say, speculative buy, rather than a slam-dunk confident pick.
Exactly, which then leads to the question, who is this really for? Who's the right kind of investor for Avanos right now? And honestly, it seems much better suited for long-term investors. We're talking about people who have the patience, maybe even years, to wait and see if these strategic changes actually work. People who want to capture that potential big upside suggested by those very long-term forecasts, like 10 years or more out. If that's you, maybe it fits.
And for short-term traders, well, they could play the swings, maybe trade around earnings or look for technical bounces. But, and this is a big BUT, you absolutely have to be ready for that volatility. It can easily whip around on you. It's definitely not for the faint of heart in the short term.
Right. And if you are considering a shorter term trade, maybe look for entry points around these current levels, say $11.50 to $12.50, where it seems to be finding some support, a logical place for a stop loss, maybe around $10 and just below that recent support to limit your downside if it breaks lower, and for taking profits, perhaps aiming for near-term resistance, maybe somewhere in the $14 to $15 range, especially if those upcoming earnings give it a boost.
Okay, so let's wrap this up. Avanos Medical. It looks like a cautiously attractive long-term idea. You've got potential undervaluation, improving earnings, but you have to weigh that against the slow growth and the significant volatility. It really demands risk tolerance. Short-term trading. Possible, but definitely riskier given the price swings and the uncertainties around the turnaround.
So thinking about all this, the potential long-term promise versus the current hurdles and volatility, it makes you wonder, doesn't it? What does this kind of cautious optimism, paired with pretty significant price swings, tell you about the kind of patience needed for certain investments, especially when a company is trying to transform itself?
That's definitely something to chew on. A great question for you, our listeners, to consider. Thank you so much for joining us for this look at Avanos Medical. We hope it gave you some valuable perspective. We look forward to having you back with us again soon for another conversation.